Right, now let's talk about Richemont, which is a core holding in many, many South African portfolios because of the historic connection with the Richemont Rupert family and the internationalization of that business. In 2008, they separated the tobacco interests from the jewelry and the watch business. So at the core of this group is the Cartier brand, which is really about high-end jewelry. Van Cleef & Arpels is there too, and then all of the other watch brands, which we can tease out. Market capitalization, 628.6 billion rands. That's if you take the South African entity, which is linked to the Swiss listed entity on a ratio of 10 to 1, and you add it all up and you multiply by the share price. So that gives you a sense of its scale. Price to earnings ratio, 44.21, dividend yield 2%. It had some wobbles,
Yes,
but it does seem to be back on track, and the share price is at an all-time high.
correct. Now let's talk about the wobbles they had. Big problem with watch sales. Now maybe take a step back and just talk about how this luxury goods segment works. They never have a sale. They never have an end of line sale. They never have a surplus stock sale. They never sell. They never discount anything that's not selling. If they buy it back themselves,
So
they will buy it back and destroy it. So if something's marked in the store at $10,000 and it's not moving, you don't get the price to $6,000. You go and buy it back at $10,000 and you destroy it.
Because there's a lot of course they've got some stores they own themselves.
Yes, they've got a lot
others
big,
which belong to other people.
Yeah, but no, look, they've got a big retail side, which is one of their big drivers. So 2 years ago, a year and a half ago, big problems with watch sales, cutting down on corruption
in
China.
That? The Chinese factor, but then also smartwatches,
but
competition from Apple.
Terrorism in Paris was a major. They quoted this quite a few times. So they had to go in and buy back the surplus stock because, as I said, they don't have discounts. They don't sell things cheaply because you've got to protect the brand because ultimately that's what you own. Now they seem to be over that. Jewelry sales were actually quite good. Watch sales weren't fantastic, but they seem to be recovering.
So effectively what they're doing is that they're narrowing the watch business because people are not really buying watches anymore or as much, and they're expanding on the production more on the jewelry side.
And I mean, obviously what happens in China is very important to them. That seems to be doing quite well. They are moving product there, and clearly the worst is behind them. So when you look at their 25 or 26 week or 5 months trading update that came out very recently, it was quite encouraging.
Hong Kong was a big issue for them too, because for various historic reasons, lots of stores in Hong Kong which cater mostly to traveling people from mainland China. Hong Kong had a terrible 2015 because remember they had all of that umbrella revolution and drama going on, and the streets were blockaded and so on. So that's also now past.
Now look, I mean, their biggest single thing in the most recent past was this watch sales. But Cartier, the jewelry side, has done extremely well.
Let's look at the share chart, because if you were patient and you held them, then you're happy, because clearly that period from 2014 to the middle of 2016, you looked like a bit of a fool if you had them, because everyone was saying, look, this thing's done its best, it's running into global issues, there's terrorism and all these other things Wayne's been talking about. But since then, it's moved higher. It's got lots of cash on the balance sheet. It's very conservatively managed. What about the management transition? Johan Rupert is clearly still the dominant feature in the boardroom, but there's been quite a lot of change.
A lot of churn in there.
One level below.
But look, surprisingly enough, the brand almost carries itself. It's not per se the management. I mean, obviously, managers are going to make sure that you don't destroy the brand value. But the brand carries itself. So you're not looking for a visionary manager who's going to change the whole business and shake it up.
Because if you want a Panerai watch, or if you want a Piaget watch, you're going to go and buy another one because your granddad had one, and because you've always associated that brand
and you will
with
buy that. So as long as you protect that brand, which is their primary job, you actually So I don't think management has that great an influence. Obviously, if they do something crazy, that's a different story, but that's highly unlikely. But now look, they've done well. I mean, they've got €5 billion cash on the balance sheet. They've got no debt. They don't pay you the dividend. They don't give you the divvy. So they're also
What do you mean they don't give you a divvy? I mean, it's not a very generous divvy.
No, they can, with that amount of cash, they can give you a much higher divvy. But clearly, they're hoarding the cash because they want to buy something, as they all do.
It's a bit irritating, the whole thing about the dividend being paid in Switzerland and being subject to a high Swiss dividend tax, and then South African shareholders have to go through this complicated thing to claim it back.
Yeah.
But it is what it is, I suppose.
But look,
So is it hot
obviously,
or not?
I'll go hot on this one. Obviously, stronger rand doesn't exactly help us. There doesn't help any of the international companies. But they've proven themselves that they can respond to tough times. And it is a core holding in a South African portfolio.
And it's been pleasing to see how
Yes,
they
for
have
sure.
adjusted the product line, which makes sense because there's times in history when people want pens and watches, and there are times when they want more different and other products. So
And they can change it,
they can change. Okay, good. We'll go hot on that one. We hold them in the hot stocks portfolio.